So terms means, especially coming from that '08 experience, terms means for us, lease purchase or owner financing.
Welcome to the Real Estate Marathon Podcast, your guide in the race to financial freedom through real estate investing and sound financial practices. This podcast is for anyone interested in learning more about real estate investing, personal finances, and a new take on traditional retirement. Now, here are your hosts, Larry Fierro and Mike Moe.
What's going on, everybody? Welcome to the Real Estate Marathon Podcast, your guide on the race to financial freedom through real estate investing and sound financial practices. My name is Mike Moe, one of the hosts of the show, here today with Larry Fierro. What's up, man?
Mike, I'm looking forward to this interview we got coming up today, man. There's some stuff in there that I profess to know a lot about real estate, and there was some stuff in this interview that even I didn't know, so I was kind of impressed.
Yeah. Chris Prefontaine. As we kind of teed up in our Monday morning motivation earlier this week, the man's got just decades of real estate knowledge that we are going to expose our listeners to just in a short bit here. And yeah, you said it, man. There's just so many different ways to kind of skin a cat and to kind of tackle real estate. And Chris has got a very unique one that I don't think a lot of people are super educated on. So yeah, ton of info on this one.
Well, and he was talking and discussing a method that I've used myself, and I'm sitting there and I realized about maybe 5 minutes into his discussion that there was a better way to do the method that I've already used. So I was doing it all wrong. So I'm looking forward to sharing
not necessarily that. All wrong. Just maybe there's a more efficient way to do it, right?
Well, my personal opinion, I was doing it wrong. So, but I won't get into how I was doing it. So just listen to Chris and you'll be interested in what he has to say.
Yeah, for sure, man. All right. We got to warm up.
I do. One of the things Chris was talking about in his interview was a subject to mortgage. And what a subject to mortgage is, as its name suggests, a mortgage that is subject to an existing mortgage. In other words, the seller is in a subject to deal, isn't paying off their current mortgage, but rather having the new buyer pay off their existing obligation.
Yeah, man. Subject to. I'm not even going to try to dumb that down. Subject to the existing mortgage, right? It's about as clear cut as it can be.
Yeah, you're making a deal to pay off an existing mortgage, and there's a lot of different ways to do that. And Chris talks about a lot of different things that he's got going on in his revamped business model since the crash in '08. So very excited to get into this interview with Chris.
Heck yeah, man. All right, let's get into it.
All right,
Chris, welcome to the Real Estate Marathon Podcast, man. Excited to have you here.
Thanks, Mike. Thanks, Larry.
Thank you, sir.
So, Chris, we'd love to kind of start off by having you give us a kind of a background of who you are and how you got started and what you're doing now.
Sure. So I'll give you a 10,000-foot view without aging myself here. I've been at this since 1991. Did some building of single-family homes. That transitioned into 95 to 2000. We actually put the realtor broker hat on and had a realty executives franchise. Then sold that to Coldwell Banker in 2000. That was the plan going in, not to make it a long-term deal. And then from 2000 till 2008, we coached people throughout North America, so U.S. and Canada. And then worked on our own investments. So that included, condominium conversions, some construction, some flips, some commercial. And then the lovely debacle of '08 happened, which is a whole chapter in my book. And we spent the next 4 years winding out all that garbage that happened. And that's how we got here today. So we'll talk about that.
Excellent.
Awesome.
Excellent.
Yeah, I'm excited to talk with you because we especially in this day and age, we talk to a lot of people who have been doing this for 5, 6, 7, 8 years. Talking to somebody who's been doing it for as long as you have and has been through so many different market cycles as you have. I'm excited to kind of dig into what you know and what we can share with our listeners today.
You just want to throw some salt in that wound, right?
Yeah. Well, you got to educate us less wise folks who haven't been through one of these downturns, and how to handle it. And it's
absolutely
wisdom that not a lot of people have. So
yeah. Well, I bought my first rental property out of high school in 1990. So I'm there with you, Chris. And
that's awesome.
He picks on me a lot about technology. So I feel it.
My son bought his first one with me when he was a junior in high school. It was a little 2-unit building.
Nice.
Very nice. That's a good time to start. So
Sure is.
now we're going to do a little bit of an overview of your niche, and a couple of questions that we had. The first one is, what does it mean to buy and sell a property on terms?
So terms means, especially coming from that '08 experience, terms means for us, lease purchase or owner financing primarily, and then more advanced buying subject to someone's existing financing. All three of those don't involve the investor going on a loan ever and signing personally. And all three of those don't involve the investor putting up cash. For example, our lease purchase has a $10 deposit built in, $10. That's what's in the agreement. So it's a great beginner thing because you're not putting money up. So that's
Nice.
what terms means in general, those three things. And we can delve into any one, but just you let me know how deep you want to go.
Yeah. Now, is that you buying and selling on terms? So you buy them on terms and then you also turn around and sell them to the next owner on terms?
Yes, we buy those three ways, and then we sell on rent to own primarily. So those are buyers that need help and or need time mostly for either credit repair, enhancement. Doesn't mean it's in the toilet necessarily, but it could just be enhancing a little bit, and or needing time to save for down payment. So those are always how we exit. Primarily, we do some owner financing too, but that's the main niche right there.
Well, that's good for our listeners, especially since our concentration is the new investors that may not have stellar credit and want to start that process and fixing the credit. So that's fantastic. Great
I had to, Larry. I had no choice after '08. So it caused us to re-engineer the whole business, to buy that way. So no, they don't have to be concerned about that.
Chris, can you explain some of these terms and these purchasing methods that you're talking about in terms where somebody who maybe not be super familiar with them could understand? So I think a lot of our listeners, all they know is, put 20 or 25% down and get yourself a rental, right? So these are some obviously pretty creative ways. So how can you explain it to somebody who might be able to understand it, who's never heard of these before?
Okay, so let's do this. Let's give an example of numbers so they can resonate. And then there's nuances to all these, right? We could give 10 examples of in a second, but let's give one where, let's say Larry's our seller, and his property, we agree that his property is worth around $300,000, and he owes around $250,000. So we're putting some equity on the table here to show you a strategy. It doesn't have to be; it could be over leveraged even. But let's go with this one. And we never talk price for the lease purchase. We talk about, okay, Larry. So if you sold it full price, you didn't, because usually we get this from an expired listing or a FSBO. We say, okay, you would have gotten $50,000 ideally out of that before expenses. And he says, yeah, okay, great. So what we're going to do is we're going to structure a lease purchase whereby we take over your underlying mortgage only after we have our buyer in place, but we'll get to that. We then will promise you, the seller, on or before 36 months is typical, but I'm just using that for the example. We will pay Larry, the seller, his $50,000 equity, and we'll pay off the underlying loan. Keeping in mind, for 36 months, that underlying loan, the principal amount is going down. So we're going to, at the end, have a spread already created from that. And so Larry's tickled pink because he gets his full $50,000 as long as he can wait. That's the only caveat with all these sellers. As long as they don't need their equity today to go buy something, that works great. And in doing that little scenario that I just gave, and then we can go to owner financing or go deeper there, we create actually 3 paydays. This is so cool for a new person getting started because cash flow is the issue, right? I don't care what you do in any business. So that scenario I just gave you with Larry, now he's off, he's fine. He knows we got his house under control. We're handling the maintenance, repairs, everything. But we're passing that on to our tenant buyer. The tenant buyer comes in. Payday 1 is we get a non-refundable down payment to make sure we have a buyer, not a renter. Payday 2, we're paying Larry's mortgage, let's say $1,200, but we might be charging $1,800 for a lease. That's payday 2 every month. Create an immediate spread. And then payday 3 is we're probably going to mark his house up to like $320, hypothetically. And then the principal pay down is going to happen. So payday 3 is pretty sizable. Our average in New England is around $75,000 per deal for all 3 paydays. So these are significant deals, and that costs $10 plus some time.
Nice. Yeah, that's not a bad deal. Throw $10 in and get 3 paydays like that. So all of these, everything that happens with the property while it's under this 36-month contract, whether it be appreciation, the principal pay down,
and the cash flow from the investment itself actually goes right into the investor's pocket, not the owner, technically, right?
Correct. The owner steps aside, literally steps aside, knows that their mortgage is covered. So for some, that's cool because they might be looking for debt relief. But in this case with Larry, we were just giving a seller who's in good shape and can wait and get that nice $50,000 at the end that they couldn't get on the market. All the repairs and maintenance that we committed to with Larry, we pass on to our buyer.
Nice. Awesome.
That's a very nice deal.
Now, do you want to do a small example of an owner financing now? We don't have to go to sub 2, but we can do owner financing.
Yeah, let's do owner financing because I'm more familiar with the owner financing aspect of it because my portfolio in New York has primarily been owner financed.
Okay, cool. So I'll throw another twist at you then. So owner financing for us, when we say that, we're referring to a house that's free and clear. So the owner's in good shape. They just want all the money and they can wait. And some prefer to wait for capital gains or other reasons. So let's see. I'll give you, instead of a small house, I'll give you a bigger house, a big example. We did a house, Larry, you're probably familiar with Cape Cod.
Yes.
There's a house sitting up on the bluff overlooking the water. So this is not a smaller deal. This is a $945,000 house. But the point is the same with every house, small or large, and that is that we make principal-only payments to the sellers that are debt-free. We do not pay interest. So picture that being a recession building strategy right there. We're paying $2,500 a month, principal only on that house. We had originally a 3-year term. We just extended it 5 more years. So we have an 8-year term. Do the calculations. That's $30,000 a year coming off of principal. That doesn't count the other paydays that we talked about.
Yeah.
So I got a metric for you. If you do this strategy on a $200,000 house or higher, and you get at least 4-year terms because of the principal pay down, knocking that down so fast, you have a 6-figure deal all 3 paydays every time.
Nice.
That's cool awesome. Deals. Now you don't get those, 3 a month, but if you do a half a dozen of those a year, you're in great shape.
Yeah, that's awesome.
And at this point, I'd just like to throw out there that you do provide coaching for people who want to get involved in this, correct?
Yeah, so we're a little unique in the industry in that there's a lot of people selling stuff, right? You guys know this. You're in the industry. And they care about one thing, selling that stuff. Our mission, our company, without going too crazy, but our mission, our values, everything we do is about helping our students. We call our higher end students our associates. I was telling Larry before the show, we have some up in his neck of the woods. And our goal is to do transactions. So yes, we provide hands-on, like in the trenches, do calls with them, get deals done with them. So it's very, very hands-on for us.
That's awesome. I think that's so important. I think a lot of people are to your point, pitching these courses and pitching these services, and they talk a lot of theoreticals and they talk a lot of high level concepts, right? But what you really kind of makes your dollars and cents is when you get down to it and you're transacting, and the nuts and bolts of what makes a transaction tick. Like, that's the hard stuff. That's the complicated stuff. And to have somebody by your side and helping you out with that, definitely make or break a new investor. So it's good.
Well, we also, to that point, Mike, we also, a few things, we're big on free, first of all, so dig into us, but on this front here with the transactions, the bottom line is we'll tell them too, like there's a whole chapter in the book called What Can Go Wrong? Why? Because other mentors have said, well, you're going to scare people off. No, we want them to know what's going to go wrong so they don't go to this fluffy seminar and then go out and say, well, how did all this happen? So they at least know how to pivot. That's life. It's going to happen.
Yeah, that's awesome. Since we're on, do you want to give the listeners kind of an overview of your company and how it's set up and how people can engage with it if they'd like to?
Sure. So it's smartrealestatecoach.com. They can pretty much find everything there. There's a free webinar. As I said, we're big on free because if you dig into any niche, I'm not so naive to think we're the only niche that right? You can go into anything like you guys do. You can go into apartments. If you decide after doing your due diligence for free, you want to go further, then we can dig into different programs. We have an online academy and things to get your feet wet to see how deep you want to go with it. I said to Larry before the show, you weren't on. So Larry, I might as well give the book a connection now, right? Yeah. So we have two best-selling books. The first one is called Real Estate on Your Terms, exactly what we're talking about here to go a little bit deeper. And they can just go to SRECbook.com. And when I say free, it's not like a lot of times you say free and then you got to put your credit card in for shipping. We will ship it. It's a hard copy, hardcover bestseller. You can see it on Amazon, but we'll ship it for free. Just go to freesrecbook.com. And you got to say you heard it on the show. Other than that, there's no criteria.
Awesome.
So the free webinar and the free book, that should get you going. And then YouTube has over 100 deals exposed. We give you all the deals, the good, the bad, the ugly.
Wow.
Good. Thank you,
Go to their YouTube channel and subscribe to that. That's going to be great content. Now, in your company, how do you go about leveraging your staff? Do you use your staff in the day-to-day operations? I mean, what do you have your staff working on?
We have an awesome team, Larry. So it's my son-in-law, Zach, and my son, Nick, and then a tremendous support team. And we're big on delegation and outsourcing. We also have virtual assistants, that we outsource to. But we do follow a kind of a cadence, a meeting rhythm. We learned from a group that helps people scale businesses. It's out in Arizona called the Lead Entrepreneur. It's not real estate. It's any business to help you scale. And so they've taught us the values, the culture, helped us with our mission, and then helped us with, the meeting flow. So everyone has their marching orders. We call them smarts, but they're basically goals to meet the mission every trimester we do instead of quarterly.
Nice.
So everybody's marching together. Everybody marches along with the values and the mission. So when you're trying to make a decision, it's all based on those. There's no real argument. Does it fit with what we set up?
Yeah, that's awesome. Cool. So let's talk a little bit about how somebody might be able to get into this. Working, obviously, a lot of people getting into real estate are working full time. How do we start building some of this secondary income? And more specifically, how does a busy professional begin the process of adding secondary income through these strategies that you're talking about?
Yeah, kind of two-tier. Most of our students, like people say, well, do I have to be full-time? No, most of our students are not. There's a few people that have made the transition, and there's a few people wanting to, but there's a whole bunch of people that just quite content to do a few deals a year for obvious reasons. They're quite profitable. So I would say the two tiers would be, one, they're going to have to go through a little bit of learning curve. Our online academy has 10 modules and like 60 videos, and they can plow through it once, but it's going to take going back like a resource center. And then after that learning curve, so let's say that's 90 to 120 days, depending on how they work and their skill level and their discipline, then they could pick away, whether it's for their own house every few years or whether it's for 2 or 3 investment properties, very, very part-time. That's just, they can turn up or down the volume and we match effort for effort. That's okay. Very easy to do that way.
Nice. Cool.
Nice. Now, what 2 strategies do you recommend that the new investors prioritize when they get started?
If they're new, I wouldn't sway them towards the owner financing method that I just told you, and here's why. If we do that deal I just told you about, and you're giving the owner no money down, you can't expect, most states have transfer tax, almost all. So you can't expect the owner to say, hey, I'm going to pay you a price. I'm not giving you anything down, but pay your own transfer tax. It's just, they're not going to do it. So you are going to have a small bill there. So the best strategy would be the lease purchase. And then we have a technique with the lease purchase called AO, assign out. And all that means is you find the same tenant buyer that the 3 of us discussed, and then you assign it over to the seller. They make most of that other profit. You only get 1 payday, and then you're out of the deal. But for a new person, super easy. The lease purchase and the lease purchase where you assign out, they're both very good for new investors.
And then what does that transition like? If somebody wants to really ramp this up and get full-time as quickly as possible, what's the average you kind of see your students take that route?
We've got, you mean time-wise, Mike? Or
yeah, or I mean, number of deals, whatever it may be,
Most people that come in, most of the students that want to be somewhat active, quote unquote, want to do like 1 or 2 a month. And they're super aggressive more than that, but that seems to be about the average of people that come to us. And that ramp up time might be, it's all different. I always say it's right here. It's headspace. It's not, we teach the same thing to everybody, right? It just, I don't know what skill sets they bring and what baggage they have up here for the mental capacity, but usually that'll take maybe between 6 and 12 months to ramp something like that up. And then we get so predictable with this though. So we've got the metrics now. I mean, we can say to you within averages, hey, Mike, it's going to take you about 11 to 17 properties that you call on to get in the door. And it's going to take you around 25 to get a contract. And it's going to take you around 35 of those visits, those calls to get an actual deal done. So then we say, okay, how much time do you have, Mike? Well, I got 10 or 12 or whatever hours. We back it out and say, okay, it does fit your goal. Or no. You've either got to ramp down your goal or ramp up your activity. So it's that predictable within reason. Everybody's, we use our averages.
Awesome. Yeah. So it's with your framework and with your averages, it's pretty easy to back into a number to figure out how hard you got to hustle to meet your goal, or whether or not you need to adjust your goal based on how hard you're willing to hustle, right?
Yeah, total numbers game on that piece. But then there's the piece, and I'll give you an example without giving his name, but there's a gentleman that joined us, and his salary was about $75,000 a year in his job. And his goal was aggressive, like almost $1 million. And I said, okay, that's great, but understand it's not going to be from a real estate skill set standpoint that slows you down. We got to get this so it's at the point where it's space between your ears, where it's at the point where you have learned enough to get into the $1 million earnings bucket. It took him 1 full year to do his first deal, and now he's at his 4th deal, but they're all like big deals. Like the paydays are all 6 figures. So was that worth the wait? And he says to this day, good thing you told me that, because I wouldn't have known that was going to be somewhat frustrating. So that's what I meant by it's different for everyone, but the paydays are well worth it if you stick with it.
That's kind of what I like how you're pitching this, man. You're talking, a lot of people go to these seminars and get these really rosy pictures of millionaires and Lamborghinis in like 4 months, 5 months, right? Yeah. And you're kind of being a little bit realistic and not under promise and over deliver. You're not trying to give them false hopes as far as what you can do, and being really realistic with the work and the time that it takes to kind of get to those goals. So that's awesome.
Well, mismanaged expectations, to your point, is the biggest headache I see in this space that I wish people wouldn't do. The late night commercials and whatnot. So yeah, we're pretty transparent.
Very nice. Very nice. Now, when you're first starting your business, how important do you feel are core values to the success of the business?
Super, because just what I was saying before, Larry, the values make it so there's no misalignment with people's decisions. Like family in the company, non-family, doesn't matter. Even if a student is applying for one of our programs where they have to apply, we make sure they fit our core values. We hire, fire, and accept students based on our core values. Some people just don't fit. And I know this will sound crazy again in the mentor space, but in 2019, we said no to 3 or 4 higher level applications that came in because it just didn't fit in the company culture. And it was nothing bad about the person, it just didn't fit. And so we didn't accept them. And most mentors would say, what are you, crazy? Just take the check. And we don't do it.
Yeah. Well, and that goes back to the being real with the clients. If it's not going to work, it's not going to work. And you have the guts to tell them that.
Yep.
Very nice. So do you think coaching and mentoring is a great way to be successful in this field, just to get it down pat? I
think any field. Like, I know the three of us talking about real estate, but this goes for absolutely any career or industry. Think of this. I'll give you 3 things. If it doesn't matter what industry, like restaurant, if you find a niche or an industry you like, then step 2, find someone in the industry that is where you want to be, but key, still doing it, like not 20 years ago did it. And then 3rd, put the blinders on for 3 years. Now, I'm not saying it takes 3 years to do every business, and it doesn't take 3 years to do a deal. But if you commit to 3 years and do those other 2 steps, you'll have a great experience. Like no matter what, as long as you're willing to learn and don't look left, right, or don't get the shiny object syndrome. Just go for 3 years. I think the mentoring is key in any business.
Yeah, you bring up a good point. Shiny object, right? Get those blinders on and pick your niche and roll with it, right? I think they're in this space, and I guess every space, right? There's so many things to get distracted by, so many new things that people are doing, especially today is with our social media. We get blasted with so many different ads. It's not very difficult to get swayed from your end goals. So having those blinders on and really having that 3-year goal, that 3-year vision is key to make sure you actually make some progress. Because if you jump and ship every month, you're starting from scratch starting from ground zero every month on a new project. So
it's the grocery line thing, right?
Yes.
They keep jumping lines. All these niches are different businesses. It takes time every single one of them takes time.
Yeah, and for sure.
Since we started the podcast, one of our running themes has been, make sure that you decide what you're going to do and kind of stay in your lane. And it's don't go with the shiny object syndrome, because you're just going to spread your efforts out. And then you're going to, instead of having one thing that you're 100% focused on, you're going to have 20 things that you're 5% focused on. So
yeah, watered down.
Yeah.
And just to clarify, you still have to be able to pivot, right? Because like you talked about, pivoting in the business is super important, kind of work with what the market gives you and what the times give you. So that is acceptable, but it's completely switching course and doing 180s every 3 months is what's going to screw you up and not allow you to get anywhere.
Yeah, very good point. You clarify that. So pivoting within the niche means what? Like in 2019, I bet you we renegotiated maybe a dozen deals. We hold like 50 or 60 at a time. But that means maybe we came upon some extra cash and called an owner and said, hey, I know you were waiting for 50, Larry, to that past example, but what if we were able to come up with 30 today? Well, we just picked up 20 grand. Or a buyer had a hiccup and they need more time, and we go to a seller and say, hey, we're going to renegotiate. We need too much. That's pivoting within the industry that you have to learn how to do. And that's some of the things that we expose and teach.
Yeah. Nice. Now you talked about different levels of activity in this. Is this something people can kind of get involved almost passively with you guys and have their money work for them that way?
Yeah, we have deals like that too. That's not active. Like they're not going to have to learn the biz, but yeah, we have deals like that. Yep, absolutely. Okay. So people do that like with IRAs or just money that's not earning, the rates are garbage out there. So if they're not earning 8, 10, 12%, then yeah, that's a good place for them.
Okay. Nice. And the last thing on the kind of this newbie perspective, what is the number one step for somebody who is interested in this and wants to learn a little bit more and wants to kind of figure out how they might get started? Is there certain preparations that they need to do in their own finances, or a certain amount of money, or a certain amount of knowledge, or where do they kind of start with to getting down this road?
Realistically, after they go through the free webinar, right? And then they say, okay, I want to do this. Realistically, to get to about a deal a month, their fixed overhead, this is super low, but just so they know it, their fixed overhead will be, ideally to me, if I set them up exactly how I want it, it'd be like $500 or $600 a month. That does not count a website. So, because some people build it themselves or know someone, we build them for some people. So it's about $500 or $600 absent the website. That gives you your lead gen, your everything you need to prospect. It gives you a virtual assistant even. It just doesn't give you a place where you're going to drive traffic yet.
Nice.
That's not too bad.
No, you can't even get a virtual assistant for less than that.
Crazy.
Yeah. Now the coaching program that you guys offer, could you talk a little bit about that? How in-depth is it? Do they have an assigned coach that's available on the telephone to run deals by, check on making sure they're not making missteps, that sort of thing?
Okay. So we've got a few different levels. So when they go through the academy, we load them up with support because of what we said earlier. People get these programs and they can't do anything. So when they get the course in the academy, they have what we call a Wicked Smart sit down once a month. It's the third Thursday of the month. And they have a Wicked Smart workshop the fourth Thursday of the month. Those are live Zoom calls like we're sitting talking today. There may be 40, there may be 80. They may be listening, they may be participating. It's okay. But those two things are free. They also have free email support for an entire year, so they can send in property sheets that way. That helps them. And then they get a strategy call. They actually get 2 live strategy calls where myself or my son-in-law, Zach, or one of the certified coaches are on the phone with them. That's at the basic level where some people live, and they're quite content with that, and they go off and do their own deals. There's a police officer that comes to mind in Jersey. Last year, he did 20-something deals. The year before that, only 8. All he did is go through the academy and then go run with it. He does not in any other hands-on coaching. And then this higher-level coaching where if they want us literally to be calling sellers and buyers with them, especially when they're new, we do that. We critique their live calls when they do them. I mean, we're super involved. Or there's group coaching, which is just passively once a week. So there's different levels for different personalities. And it's not about ascending to different programs. It's not. It's about, does Larry fit here or here? It's not. There's a home for you because we've defined our avatar quite distinctly. And so we know where you'd fit for the most part.
Awesome. All right, cool. Let's pick that brain that's got all this knowledge around the market cycles and this however many years of knowledge and figure out what are you doing to recession-proof your business. Obviously we're not in the beginnings of an upswing, right? We've been on a little bit of a tear in the last handful of years, and I'm curious to know what are you doing that the listeners can benefit from to, I guess, recession-proof their business, and if they're interested in doing this specifically as well.
Yeah, I'll never say recession-proof, right? But I will say recession-resistant. And everything we've done since entering the terms market is for that reason. But the way to make it even more recession resistant is to do longer terms. Think about it. If I do that house in the water for another 8 years, I care. I'm not going to say I never care, but I care a lot less with any of this the garbage going on in the markets. And just so you know my thought on this is nobody can predict it, but it's not one market, right?
Yeah.
We're fortunate enough now to have associates all over North America. So I can tell you some pockets are hot. Some since 2013 have been flat and they're going to stay that way. And that's great. So we can buy and sell in any market now on terms, no question. And then if the banks ever slow down again from the buyer side, Great. You're the only game in town offering terms. You're like the only door open. That's what happened in 2008. If you were in the terms business, we were not.
Yes.
Yeah. So that just by the nature of the deals, it's recession resistant.
Yeah, as much as you possibly could be. So, so we are teaching the students now, and we're doing it personally. So we only teach what we do, pushing the terms out further and further. We used to accept 3 years as the norm. Now we're seeing our students get 5, 7, 10. That's super cool because these are new people, and they're learning from us going through it, going, hey, why don't we push it out now? Now language just changes.
Yep. Now, just out of curiosity, if they choose a term that's too short, do you automatically write into the contracts that you have an opportunity to renegotiate the terms and they have to listen, or is it something that you just renegotiate as it pops up?
We've done both. You're going to be much more successful and have less stress if you just upfront say to them, look, I get that you like that, but I need to know that if my buyer's in there and everything's going the way it should be, we're not going to take their legs out. You're going to give me a 6-month extension. So you can build those into the contract, or all the contracts are contingent upon a buyer anyway, and especially for the new person. So what you can do is just make sure when you're pre-qualifying that buyer, you're getting an absolute killer buyer, or don't do the deal. High down payment, great income, longevity, the job, everything lines up.
So a lot of this strategy, well, I guess all of it revolves around not putting your own balance sheet on the line, right? You're not really signing on the dotted line for any of this debt. Yeah. What would you say for a lot of investors nowadays who are getting started and feel like that's the only option to sign these recourse loans and sign on the dotted line, not necessarily in this strategy, but for any real estate investing strategy that they're trying to deploy?
Don't. There's just no reason to. Here's the deal. Even if they're single and they're not married, they don't have a family, they're putting their assets on the line, period. And the banks do not care if the market goes down or if the market's soaring and they decide to change ownership, because I've seen all of this. And they just call your notes. This happens. So don't do it. I had good credit before 2008, and that's why everyone was doing it then. Don't do it even if you have good credit. More reason not to do it.
Nice.
Yeah. So when everything goes south, the bank doesn't really care, and you could lose basically everything.
Can and will.
And will. Yeah.
Yeah.
Now, when that happened to you in 2008, what were some of the takeaways that you had from that? I mean, obviously it changed your entire outlook on business, but what other takeaways did you get from that downturn?
Definitely two. I think it was Mike's point with having either a mentor or a sounding board or whatever because some people do that with past mentors or people that aren't even living anymore, right? Have some kind of a sounding board. I prefer someone that's the 3 criteria that I said earlier that's in the industry. And then on the direct side, just never sign personally and don't pledge your credit. Don't be tempted to do that. Those are the biggest.
Oh, very good advice. Very good advice. You've been talking about the subject to and all of those. Is there any one of those contracts that you prefer, that you like the best?
Owner financing with principal payment. Yeah, no question. For obvious reasons, you pound the principal down, so you get in the recession proof and the profit, recession resistant and the profit.
Yep, and the no interest is. I just all of the owner financing that I did, I paid like 5% interest on. So I'm wishing I could go back and renegotiate those contracts, and I'll be looking.
It's funny if you give them their price, Larry. A lot of people just that's their, whether it's ego or whatever it is. If you get their price or higher, you can structure almost anything you want.
Which is awesome. You can decide the price. I'll decide the terms. How about that? Well,
that's pretty much the chat
all day.
Yeah.
What do you see as the biggest mistake new investors make getting into this space?
Besides those things that we just said?
Yeah.
The shiny object syndrome, jumping. It really is. Because everything's on the internet now, that is the biggest. So we kind of touched upon it without touching upon them. It's those two things.
Okay, nice.
Well, I'm flabbergasted right now and kind of speechless because it's just, you never think of these things until it's actually presented to you. The way you
I didn't do them
today. Yeah.
I've been at this 29 years. So before 2000, end of 12, I didn't do them. I didn't know precisely how to pull it all together.
Yeah. Now I'm curious myself, where do I go to look into, and is it the website to look into the coaching?
smartrealestatecoach.com is fine. And that's where the webinar lives. And we're going to give them the book anyway through your link. So the webinar is your best bet. If they don't mind dealing with me for about 50 more minutes, they'll get a little more content and then they can decide where to go after that.
Very nice. Very nice.
Awesome.
Oh, go ahead, Mike.
I was just going to say definitely an impressive strategy, and definitely something that folks should look into a little bit more as they're looking to get it started and get started with, as you said, little as $10 for your first contract and $500-600 a month for overhead for doing a deal or two a month.
Not too shabby.
Seems like a good framework anybody could follow. So,
and everybody's got $10 for a down payment, so that's definitely a plus. I hope too. Now you have a podcast also. That's the Smart Real Estate Coach podcast. Is that the name of the podcast?
Yep. Smart Real Estate Coach Podcast.com.
Yep. I recommend everybody goes and subscribes and leaves them a rating and review on iTunes, because this information is just mind blowing. It'll change your life.
Appreciate it, Larry.
So, well, that's everything I've got for Chris. Mike, you got anything else?
Nope. Likewise, man. That was awesome. Tons of good information. And yeah, all the links will be thrown out in the show notes as far as where people can go to get a hold of you, your website, anywhere on social that people can connect with you, Chris.
We're on all of them. Instagram, Twitter. The big ones for us would be Facebook and YouTube, because we have all those videos on YouTube.
Nice. Awesome. Cool. Yep. But no, that's it. So we appreciate you taking the time out of your day and sending your knowledge out to all of our listeners, and hopefully people can take advantage of it and get involved in this space. As it's definitely an interesting niche that I think people can do well in if they put their mind to it and get some help from you.
Same here. Pleasure, guys. Appreciate being on.
Thanks, Chris. Take care.
All right. And that, ladies and gentlemen, was Chris Prefontaine. Larry, how about that one, man?
That was awesome. That was just plain simple. It was awesome. The stuff that he talked about with the owner financing without doing any interest on the mortgage. I was just like, I've done at least five owner finance deals, and I've always offered to pay interest. And he just was like, no. And I go, spending too much money for that. That was the one.
This interview proves a handful of things. One, there's 100 different ways to get into real estate, and definitely more than that, because this is obviously one that I think not a lot of people know about. It's a really interesting way. But also there's win-win-wins in all scenarios, right? I mean, obviously some of the sellers were more than happy to get out of their current situation for what Chris was offering, and he was getting it into his wheelhouse with no interest, with some of these really, really awesome terms from these owner financing. So yeah, man, definitely some key takeaways from this one.
Yeah, we need to do an entire episode alone on just a couple of the things that he said, bring him back in and be like, all right, we need to delve into this a whole lot deeper.
That's a solid idea, man. We should do a whole episode on owner financing. How about that? We got the owner financing guy right in front of me. Oh, Mr. Fierro, right here.
Yes. That's what my forte is, actually. So I'm going to be discussing that on a couple of shows coming up, and we've got a bunch of stuff going on, and I just going to delve into it a little deeper and try and expand even my knowledge on it. So
heck yeah. All right, man. Takeaway. So there's a lot to take away from this one, but I think the one that I would like to challenge the folks to is creative financing. If you guys are going at this thinking the only way to close a property is the bank and 20% down or 25% down, then you need to challenge yourself to look a little bit deeper. There are going to be properties in your future that don't necessarily qualify for bank financing, or you may not be able to get done in time, or maybe it just doesn't make sense with bank financing. So there are other creative ways to get properties done. The challenge to you is to look into those. Start your research now, whether it be these ones we discussed with owner financing subject to, or the dozens of other ways of getting into properties creatively that don't necessarily always involve 25% down in a bank.
Yeah, and practice talking to people, because one of the keys to having any of these creative financing is you've got to delve into why the seller is selling. Are any of these creative financing methods going to help them accomplish their goals at the same time helping you accomplish your goals? So you've really got to talk to the people and listen to their answers.
Yeah, and I think that's one of the biggest missed question when people are looking at deals is, why is the seller selling? If you can figure out what that motivation is and figure out what their angle is, then you might be able to find that win-win-win that we talked about with Mr. Prefontaine.
Yeah, you got to ask that question well before the closing table.
Oh, for sure. Yeah. So, all right, you guys heard it. Get out there, look into some additional options for the creative financing side. So that's just another, I guess, tool in your tool belt, right? So if it comes across your plate that doesn't necessarily work with straight up bank financing, well, you got another option if you've already done your homework and you know what these other options are for you to bring to the table to the seller, or to the seller.
Yeah, and I'm called the triple threat, but when you get some of these tools in your tool belt, I'm a quadruple threat. I'm, a septuple threat. There's a lot of different ones. So
yeah, there's tons, man, and it just pays to know, right?
It does. So
cool.
That's everything I've got, Mike.
All right, man, that's it. So thank you guys for tuning in to another episode of the Real Estate Marathon Podcast. We'll see you next time.
Have a great one.
Thanks for listening to the Real Estate Marathon Podcast. If you found value in any of the content from this show, consider supporting us in the following ways. Subscribe to the Real Estate Marathon Podcast. Leave a rating and review. Continue the conversation with like-minded individuals on social media by heading over to the Real Estate Marathon Podcast Facebook group, or follow us on Instagram and Twitter at Real Estate Marathon Podcast.